There's no question the authorities are extremely supportive of the financial inclusion agenda in India. There's clearly been a level of effort, attention on the issue that is actually quite unusual across countries. But I would like to make 3 points from comparing what I see in India versus other countries. First, it seems to me the regulatory authorities have perhaps been a bit overly cautious, where they started with a very restricted system, and over time they've loosened up the regulations to make it more commercially viable. I can understand that perspective of starting in the early days when you don't know much about it in a very restrictive fashion and then opening up as you gain more experience. But the problem is, or has been, that this really taxes the providers, because there's been too many instances where people have tried things and it didn't really work. Then there's a regulatory adjustment and they try again and they try again. Every time there's a failure, there's energy that is being sapped. So I think moving to a conducive environment that creates a commercially viable situation, I think it's important to reach that situation quickly rather than gradually. Second point is that I think for financial inclusion to work, we need to bring in an element of disruption. And I know this is tough always for regulators to accept the notion of disruption. But financial inclusion is disruption. And we're talking about going from a situation where 40 or 45% of households have access to an account to a situation where 100% do. That's disruption by definition. You cannot achieve that without disruption. And I think the kind of disruption that we need is different types of players bringing different approaches, trying their hand at it. I personally think that in this phase of trying new approaches, we need to broaden the same range of players who can orchestrate financial inclusion solutions. I think it's entirely legitimate to introduce a new class of players, which we could call e-money issuers. We could call them banks or not. I don't think that's so important, the actual label. But importantly, these are institutions that do not invest people's money. They do not intermediate funds. What they do is act on the front end of the bank, taking deposits, managing BC networks, offering accounts to people, doing all the front end stuff on the liability side of the balance sheet, the capturing of deposits, but don't themselves invest it. All they can do with those funds that they raise is to stick them into a bank account. A bank that's already prudentially supervised, and that then takes care of the safety of the funds. That e-money issuer regulation exists in many countries, exists in Kenya, exists in Peru, exists in Mexico, and is working very well. The dichotomy is not between unlicensed deposit taking and licensed banks. The dichotomy is between institutions that only capture deposits without investing funds and full banks that invest that money through their lending or investment operations. I think if you had that sort of legal figure of the e-money issuer, then we could broaden the range of people who can try their hand at building this very complex ecosystem of BCs. This would open a path for mobile operators to leverage the fact that they have so many customers, the fact that they know how to run distribution channels, the fact that they own a real-time communication network. We could leverage those skill sets more directly to the cause of financial inclusion. This is not about disintermediating banks, because remember that all the money that they would raise would go into banks. Banks would be spending that money. So all we're doing is to put a specialized institution in the front-end management of low-value accounts. Accounts which, frankly, banks have not demonstrated that much interest in owning. So let someone else do that for them. I think with this sort of regulation, you would open the range of players who can try different approaches to achieve financial inclusion. The fact is, banks have never seen, and not just in India but elsewhere, have never seen banking as a mass market product. Mobile operators see their core business as a mass market product. So they already have that sort of aspiration to serve everyone, which is not so natural with banks.